All right, we're off and running live at RealCapital. This is the Commercial Real Estate Podcast. I'm Aaron. He's Adam. And this is Rob Kumer from Kingset Capital, the CEO of Kingset Capital.
Good morning.
Rob was on a couple years ago, just fresh out of COVID. We're not going to go there. I don't want to relive at all the conversation we had because it will trigger me.
It was literally the first conference, live in person conference.
Let's not go there, man. Let's not do it. No, let's not. I don't want to think about it. We're here. There's no thoughts of COVID at all. There's lots of other things going on in the marketplace, though. Just a few things, and we're gonna go there. We're basically gonna dissect the psyche of the commercial real estate community right now. What the heck's going on, and what your thoughts are on it. Before we do that, last time we had John, I'm not sure you had the role you had today. Now you've kind of taken over from John.
That's right.
And so I'm curious, just in the last couple of years, what it's been like, kind of taking over from somebody like John Love, and how you've been slowly sort of getting your fingerprints on the culture and the I don't know what you call it, just the aura of Kingset Capital.
Yeah, so thanks for the intro. Good to be here. Good to be with you. Look, I don't think you ever really completely take over from John, to be frank. John's still around. He's still engaged. He is still our executive chair of the firm. He is relinquishing some day-to-day activities, and he does that on an increasingly, meaningful basis as time goes on. And me, along with the management team, I mean, it's not a one-man show, right? So me, along with with our management committee, which is comprised of sort of the top, six people on the executive team, are backfilling a lot of what John was doing. And we're putting our own mark on it by, the ideas we bring to the table. We've expanded the business. We're doing things today that we weren't doing, a year or two ago. The culture's a little different. The way we communicate with the broader team is a little different. The team's bigger. So there's a lot of things that we're doing differently. The way we communicate with our investors is different. It was very personal when John was around day to day, doing it, day in and day out. John's style of communication, particularly with investors he knew personally, was a very personal, high-touch, bespoke type of communication. Today, it's as transparent as it's ever been. But we have more investors today, more stakeholders. It's a broader business. So it requires different kinds of things, right? We're investing in technology to help us out with some of that. The team is bigger, so we're doing things more on there's more leadership training, there's more continuing education, there's more focus on culture with the same intensity around core values, which John was, a huge part of, obviously, in developing. So, it's been more of an evolution as opposed to a revolution. It was never supposed to be, okay, John's out, Rob's in, let's reshape the whole business. This is about continuing the legacy that John built and figuring out how to make it bigger, better, more efficient, more refined, more productive, but really keep the same focus on the core set of values and deliver the same results for our stakeholders that we've been doing over the last 20 years.
I mean, institutionalization is inevitable, right?
Sure.
With growth, right? It's just, you can't avoid it. You try your best to keep it as quick and nimble and efficient as possible. Maybe just talk about the growth that you've experienced. And I knowing Kingset, I'm guessing here, but I think the entrepreneurial, the sort of quick decision making, that nimble flexibility is core to sort of who you guys are. And I've seen it, I've witnessed it in multiple aspects of your business. But it's tough as you grow and get bigger and bigger. How do you manage that?
It is tough, but it starts with there's a core belief that we can push if you hire smart people, and we've got amazing people. If you hire smart people and you empower them and you engage them and you push decisions down through the organization, you can maintain a lot of that nimbleness, a lot of that flexibility, that entrepreneurial mindset and DNA that was there in the early days. And it starts with the leadership at the top. So it starts with being around John in the early days and understanding how he operated and how that mindset was effective. But then also, making sure that filters down to the balance of the organization. So we spend a lot of time trying to figure out how people can be empowered to make decisions. And when we send people to meetings to negotiate things, for example, negotiate joint venture arrangements or loan agreements or purchase agreements.
Kingset's a pain in the ass to negotiate with, by the way.
Are we?
Just saying.
Then they're doing a good job.
That's a compliment. That's a compliment.
But when we send people into a room to negotiate something, they know that they're empowered to make those decisions. Now, they're not forced to make decisions, so they also know that if they're not comfortable making a decision, that they always have the right to say, I got to think about that. And they have a team to whom they can bring stuff back, process it, and, make a decision outside of the room. But they always know that if they feel comfortable, that they are empowered to make those decisions, and they won't be criticized for making a decision that perhaps I wouldn't have made or that John wouldn't have made. And that started always with John, who would always tell me that, look, you're going to go in, you're going to be negotiating things, making decisions on behalf of the organization. He didn't want me always making the decision that he would have made. That would have been a bad approach. He wants me making the decision that I want to make. And he trusted my judgment. And in turn, I trust other people's judgment. So that's the way we operate. I think it's worked well so far. And I'm so proud of the broader team in the way that they conduct themselves, the values with which they live by, and the business that we've been able to do over the last, so many years. So we've got a great team, smart people, good judgment, good values. And ultimately, people make mistakes. It's the byproduct of making decisions. No big deal. We learn from them and then we drive on.
Well, you mentioned growth. What areas of your business are you seeing growth right now? Where are you hiring people? Where are you trying to hire these smart people?
Yeah. So we've hired people right across the whole platform over the last couple of years. We're now close to 180 people across 3 offices. The lion's share of the team is in Toronto. We have a small office in Vancouver and a small office in Montreal. The most growth over the last number of years has been on the credit side of the business, just from a people perspective. We've gone into the CMHC lending side of credit, so that's required a whole new team of people that have come on over the last 2 years. We were in the prime lending, residential lending space. We're not anymore. We've now backed out of that business, but that required some growth back about 2 years ago as well. The credit side of the business has been, from a people perspective, where we've seen the most growth. All that said, the equity side of the business has also grown, although it has been perhaps more efficient. It's less about people and it's more about capital, assets under management, and scale, not so much headcount. So the equity side of the business, our affordable housing business has really taken off over the last couple of years. We've got some great things going on in our residential development business, and of course our growth funds and our income fund have all been moving along, and they've all got capital today to continue growing, and that's been so it's really been a broad-based strategy over the last number of years.
When John was on a couple of years ago, one of the things that he was espousing over the episode was just the pivot to, you talked about affordable lending, and he was using words like impact lending and impact investing. Maybe lending is the wrong word, but I'm sure that's part of it, whether it's the credit or the equity side. Mm-hmm. How does that play a role in your thesis, as sort of, I think at least the way it was described at the time, was sort of core to the business?
It is core to the business, but what distinguishes our what you would call impact investing or impact lending, what is core and what distinguishes us from many of our competitors, is that we don't view impact investing as just simply trying to do good. What we're trying to do is marry up impact investing, so social benefit, with actually generating economic returns that make sense and that ultimately attract capital. Because from our perspective, you can't scale a socially beneficial idea unless you're generating returns. You can't raise capital.
You do have fiduciary obligations, right?
You have a fiduciary obligation. Ultimately, if you really want to have an impact, if your goal is to really have an impact, you have to scale it, right? Not having scale means not having an impact, really. So our goal has always been to find ways to do good things with our capital, but generate returns at the same time. So, for example, our zero carbon strategy has never been about a cost center, whereas many of our competitors look at going zero carbon as basically just a way to invest capital so you can market yourself as going zero carbon. We're actually generating returns through it. So whether it's the Royal York, where we went zero carbon, retrofitted a 100-year-old hotel into a zero carbon building through a $65 million investment. We financed it through the Canadian Infrastructure Bank, low fixed rate financing from the feds. There was a mid to high single digit unlevered yield on that. When you layer on the financing structure, there's a double digit levered yield on that investment. Our zero carbon strategy at Scotia Plaza has always been about attracting new tenants, attracting higher rents, more demand, which ultimately leads to value there as well. And that's sort of how we are rolling out that strategy. So our impact affordable housing, another example, we raised a fund, $180 million affordable housing fund a number of years ago. That capital has basically been fully committed now, where we're building affordable housing projects, market housing, so housing that you would live in or that I would live in. It's not substandard housing. This is market housing, providing it at affordable rents to those who need it. But through financing structures, deal structures with the city and with the province, figuring out how to generate returns that are actually really compelling. And we're generating now growth, our opportunity fund level returns with our affordable housing strategy. So that, is an example of something where we started, we figured it out, we sort of cracked the code. It took us 5-7 years to figure it out, but we've now cracked that code, and now we're doing a second follow-on raise, and it's a way of proving out the thesis that we're not just here to do good. We want to do good, but we're here to generate returns and therefore attract new capital, scale the idea, and that's how you really long-term have an impact.
You mentioned the Royal York as an example. For anybody not familiar with Toronto, it is a flagship, we'll call it, just beautiful hotel right around where we are right now. For that asset, how critical was the financing in order to make it financially viable? If you had to finance that if you were to undertake that effort unlevered, is it still worth it?
Yeah, so it's critical. At the end of the day, it's a critical piece of figuring that kind of project out. It's a $65 million gross investment in the hotel. To think about doing all of that with equity would have been a Herculean task. I'm not sure you would have had as much support for it. And ultimately, again, it goes back to figuring out how to generate compelling returns, not just for that deal, but so that you can raise the money again to do a second deal. You want to have an impact on this world, if that's really what we're talking about. I'm not talking about checking the box and putting it on a brochure or putting it on a website or putting it in a sustainability report so that you can tell people you're doing stuff. If you really, at the grassroots level, want to impact the planet, then you got to figure out ways to scale the idea. That's how you make things happen. And to scale ideas in today's commercial world, you have to generate commercial returns. That's just the reality of it. And until you accept that premise, you're not going to be able to really have a broad speaking impact that is really fundamental to doing all of this. I mean, what are we doing it for? Is it so that you can put it on a brochure and tell people you're saving the world?
Well, yeah, that is why they do it. I mean, it's funny. We've been fortunate enough to have interviewed people from all over the country, all over the world, and North Americans have a lot of skepticism towards what you're saying. I think even listeners right now be going, I'm not sure that's real. Like, they're probably generating return, but it's like 6% or 8%. Like, they're making up numbers in their minds where it would dismiss the value of what you're creating and the attraction of the new capital. We've had Europeans on who this is just table stakes. It's a very competitive market. So there are lots and lots and lots of funds chasing opportunities to turn buildings through retrofits and energy retrofits and affordability, because impact investment is core to the whole industry.
Yeah, and Europe, Europe's ahead of us in terms of regulation, and they've got a whole bunch of other things going on, right? Sure. And as I understand
stick versus carrot, I guess.
Yeah, stick versus carrot. So they got a whole bunch of other factors at play, but from our perspective, this isn't about. For us, this is not about just telling people what we're doing. This is about finding ways to create value while doing it, knowing that if we can find ways to create value, we can raise scale capital, scale the idea, and really have an impact. And ultimately for us, that's the goal. Let's actually have an impact.
Let's go to the market. Before we go there, just throw out the numbers. Total assets under management?
Today we're about $19 billion of assets under management.
That's credit equity and credit, or just equity?
It's both equity and credit. Okay. And we measure things sort of differently on different sides of this. So it's always a tough number to I think the 2019 or 20 billion, just to use round numbers, 20 billion, I think underestimates the scale that we have. I mean, the fact is that, the reach that we have is national. It's across all of the asset classes, across all of the markets in Canada, and across both sides, credit and equity. Yeah.
I mean, 20 billion sounds like a big number to me, but I don't know.
We become desensitized to it. The fact is, like, whether you're working on a deal with 6 zeros or 9 zeros or 12 zeros, at the end of the day, it doesn't really matter. You got to be focused on what the economics are and what the risks are, and figure out how to make money for your stakeholders.
Yeah, agreed. Okay.
Are we into the next cycle?
Yeah. Well, no, I hear. How would you define the market today?
The way I would define today's market is that we are in a capital recession with a very solid operating environment. And actually, for investors, so for organizations like ours who are looking to invest capital in new opportunities, that's actually a pretty good set of facts, because the operating side of the business is pretty constructive. Generally speaking, across the portfolio, and I think if you walked into that room, into the RealCapital conference across the hallway, and asked many of the people in that room about how their portfolios were operating, I think you'd get a relatively consistent answer from all of them. The portfolios are generally operating pretty well. Buildings are generally full. Tenants are generally paying rent. Rents are generally growing. I mean, that's all a pretty good set of facts. Now, there are spots of the market, there are parts of the market that are perhaps operating a little less optimally. Like if you're in parts of the office world, there's some challenges there. If you're in some markets, there are some challenges. But broadly speaking, the operating side of the business is very constructive. All that said, we are in a capital recession. The capital in real estate is flowing away from the asset class, and there's a whole bunch of reasons for that. I think Canada also is a little bit of the eye of the storm, right? Where this market has been dominated for so long by Canadian institutions, pension funds mainly, and insurance companies, and a lot of those groups have found themselves overweight Canada, overweight real estate, and they're taking their capital either out of real estate and placing it elsewhere, or they're taking new capital and placing it elsewhere. So there's not the same kind of critical demand for hard assets today in Canada that we've seen over the last, call it 15 years. That's led to softer prices. So where are we today? We've got buildings that produce good, solid, growing, reliable income, and values that are down. What's wrong with that? For a group like ours who have capital to invest and who are looking for better returns, this is a perfect environment to find more return through cash flow, less through capital appreciation. So that by definition lowers your risk. You can move up the quality spectrum. So you can now actually get your hands on what I would call our institutional quality assets. In some cases, best in class assets at yields that you never would have dreamt of 5 years ago. Financing is available, and it's actually relatively cheap. I mean, I know everyone talks about how interest rates are higher today than they were, and they are. But broadly speaking, and by historical standards, interest rates are actually pretty cheap. And the spread between cap rates and your interest rate are actually pretty wide. And so for me, that's sort of the holy grail, right? Buy best-in-class assets, income producing, cheap financing, solid, growing, reliable income. Sign me up. Show me where I can get some more of that, right? And so I'm pretty optimistic about where we're going. I love the current vintage of investments that we're making. So all of the stuff that we've been doing over the course of 2024 and now as we enter and get into 2025, all the stuff we've been doing, I think we're going to look back in 5 years on this vintage and say, man, that was a good spin. That was a good spin for 24, 36 months. And it's not going to last forever. So I think people got to get off, get out of their chairs and get going and find stuff to do, because there are some great opportunities in this market.
What's driving the fear?
I think there is a lot going on in the world, right? So between
how do you marry your optimism with sort of the geopolitical noise that's occurring? Right?
I cut out the noise.
Yeah.
I cut out the noise, and I think most people, many people are not able to cut out the noise. There's so much going on, and we're bombarded, minute by minute, hour by hour with news. And I'm using air quotes for the word news. How many times can you see a picture of Donald Trump with that scowl on his face in the Oval Office, saying, okay, now he says tariffs are, you read this morning on Bloomberg. I'm just picking a random example. Now he says tariffs are going forward as scheduled, as planned. Okay, well, isn't that story now a month old?
That seems old to me.
I mean, it sounds old. It's like, who cares? Like drive on. We got to find stuff to do, and the reason why the world is fearful is because there's a lot of noise. So you got the whole U.S. Trump administration. You have geopolitical risks in Europe. Obviously, the Middle East has not helped at all. You have economic turmoil in Europe. Canada all of a sudden wakes up and realizes that it's vulnerable, and it is vulnerable. But that said, we also can control our own destiny if we can get our act together. And so, like, you got to be able to sit down and say, okay, like, what are the core risks of making this specific investment? And in today's world, you actually don't have to do that much to make good returns, right? You basically have to buy a building and maintain the income.
What spread do you need above interest rates to make that investment make sense? Let's assume no capex and rent growth. Let's just assume sort of stable. What is that delta that you look for?
You typically, by historical standards, you'd look for like 200, 250 basis points.
Thank you for saying that.
Yeah, like that.
Thank you. Yeah.
But today
that's achievable now.
Today it's wider than that. Well, maybe not so much in apartments. Apartments are a little different.
I heard retail strip and GTA going for 4 3/4 right now, and the financing is 4 3/4.
I wouldn't buy retail,
but it's
strip.
happening. I mean, sorry, and then I'm gonna go.
It's a zero lift for the record.
Yeah, go through. I want to hear your logic, and then I want to talk about what's transpiring, because I think this is part of the challenge we're facing. Go ahead.
So, I wouldn't necessarily buy res today. I wouldn't necessarily buy retail unenclosed strip today. I think you're right. Those cap rates have not really expanded. And when you compare the risks, the risk-adjusted returns with those kinds of things to what we're seeing in other asset classes like enclosed retail, office, and we can talk about office, but office, some industrial, depending on geography and type, but some industrial, the returns don't compare. You can buy best-in-class office today, office today for
8 caps. I was hearing.
Yeah, like I haven't seen an 8 in fairness, but not in a market that you'd.
Fair. Yeah, maybe not in the Vectom. Yeah.
But to that point, I mean, you certainly see in the high 6s into the 7s,
right?
And you can finance today, in the high 4s. Mm-hmm. So your spread today is wider than historical standards. And then when you layer the spread on top of the absolute numbers, because as the cap rates move up, your levered returns grossly accelerate. You can make opportunity fund returns by buying best-in-class income-producing assets. And all you have to do is have a fundamental underlying belief that you can lease the space and maintain income, and at some point sell it for basically what you paid for it. That's an amazing set of facts.
Yeah.
Well, so you mentioned 24 to 36 months is this potential time frame for this window, this opportunity. What would be some of the catalysts that will close that window?
Yeah, so I threw that out there. I don't know if that's necessarily I haven't really thought that long and hard about how quickly the market rebounds. The catalyst is, you need people to feel like you need investors to feel like they're on solid footing. And I think that goes to geopolitical solid footing. I think it means that we need obviously a government in Canada. I mean, at the moment, think of all of the uncertainty, right? We don't even have a prime minister. I mean, we have a prime minister who's pretending he's still prime minister, although we all know he isn't. It reminds me of remember the Seinfeld episode where George Costanza quits and then shows up to work the next day and pretends like nothing ever happened? That's sort of like what Trudeau's doing, right? He quit, but he's still like flying to Kyiv and like pressuring Donald Trump to do it. And you're like,
announcing billions in rails.
Didn't you quit like a month ago? You told us you weren't prime minister. Anyway, we digress. But
for those that don't know what Seinfeld is, that's an episode. That's a TV series.
That's a TV series. Yeah, for all you Gen Xers out there. So, anyways, now I forget where we were. But okay, so. I don't know what the time frame is, but I think you need people to really feel comfortable that we are on solid footing on a whole bunch of different metrics, economically, politically, geopolitically, et cetera. And I think we'll get there. It's going to take some time. And I am very optimistic that this whole about face that we're seeing in the U.S. has really put a spotlight for Canadians on the kinds of things that are within our own control that we can get going on in order to control our own destiny. Things like interprovincial trade, energy, immigration, taxation, regulation, all of these factors that we actually control. We actually control our own destiny, and they could have an enormous impact on the way this country operates. So I'm optimistic that we're going to figure that out. We're going to, finish the year, maybe the back half of this year, with a leader in place who will put together a pro-growth agenda, and set ourselves up well for the next 10 years. At the end of the day, the last 10 years have been a disaster, and I think the next 10 years are going to be way better. And so, for all that, real estate should be a big beneficiary of all that.
I like the positivity, but I was going to focus on maybe one negative element of the market. You did mention
the lender.
It's all downside. Right? Yeah. It's all downside.
You mentioned that you'd, I guess, stopped your prime-based lending program. What kind
single
of single family? What kind of assets were in there that were causing problems, or why was the decision made to move away from that?
We couldn't.
Because First National dominates the space. They just didn't want to bother competing against us.
You know what, the spread, it wasn't, there were no problems. There actually were no problems. We got into the space, anticipating that we'd see some problems. And we built that all into our financial models. And at the end of the day, there were no problems, which I think, broadly speaking, is sort of the experience.
You weren't doing it right then.
The spread's compressed. We actually just decided we couldn't make enough money doing it, so we stopped doing it. Yeah, that's all it was. I'm
going to go a little out there, but I'm really curious what your thoughts are on this. And I'm going to have a hard time maybe explaining this, but I'll try my best. So, talking about, I think in general we're talking about the cycle and where it goes, and Adam kind of asked a question about the time frames and how do we get going, and how do you kind of tell it's going, and your optimism saying, like, let's just go, because there's a lot of fundamentals that make a lot of sense. So why are we not going, right? Mm-hmm. Like if you think about just the upswing, one of the things that I recognize or have noticed as we've had these conversations, and you're really comparing to the US, forget the politics of it all, just talking about sort of the fundamentals of real estate, where they're much more willing to just mark to market, write off, just reset and go. And in Canada, there's just this unwillingness to recognize it. And I asked you that question about spreads to interest rates, cap rates to interest rates, because it is, I think, fundamental to just, the yield and return and how our business really functions when you get down to the basis of it. And I've asked that question before, what's that spread? What should that spread be? And you said 250, which is great. Some people have said 50 or 75. And I go, it depends on what asset class you're in, maybe to a certain degree. But I think historically, 200, 250 is the right answer. My sense is that there are a lot of people in this industry that for 20 years have been riding this wonderful wave of declining interest rates, rising rents. Now all of a sudden it's a lot harder to make the math. And there's this unwillingness just to recognize that, that thing I bought for 20 million, it's actually worth 16 now. And let's just reset it and let's move forward and sell it at 16 and buy something else, and that will ride back up. Like it feels like this Canadianism, we're just so unwilling to let go that,
So I think it's deeper than just being Canadian. I don't think it's national pride that's stopping people.
No, but it seems unique to us, at least compared to the Americans. Right? Yeah.
It is unique to us as it relates to when it comes to the Americans. And I think there's some more basic fundamental reasons for that. First of all, the whole lending environment in the U.S. is a lot different than it is in Canada. So in the
personal
U.S.,
recourse?
In the U.S., most of the real estate credit is funded through the regional banking system, not through the big banking system. So the regional banking system doesn't have the same tolerance to, allow borrowers to keep sort of extending things and brushing things over. There was more pressure from the lending system in the U.S. as values started to fall. So that's first of all. Second of all, a lot of it is CMBS financed in the U.S. as opposed to Canada. When you have CMBS financing, there's no relationship, right? If I'm a borrower in the U.S. and I've taken out a loan from XYZ regional bank, and XYZ regional bank then package it up and syndicate it out to the market, I can, the proverbial throw the keys back. You can throw the keys back and not really tarnish any relationship, because the lenders are effectively retail investors or
the bondholders. So you don't have that same relationship impact by throwing the keys back, so to speak. So that's reason number two. The third reason is obviously the recourse issue. So Canada, most mortgages are recourse. In the U.S., most mortgages are not recourse. In fact, very few mortgages are recourse. And again, that allows borrowers to be a lot more, indifferent to defaulting and throwing keys back and writing values down and throwing stuff back and walking away and, all that sort of good stuff. So we don't get a lot of that in Canada. The other part is that ownership in Canada is a lot more consolidated, right? We're a smaller market, but also a lot of the big assets in the U.S. are owned by REITs, private investors, high net worth, and so on.
Most of the big assets in Canada are owned by institutions. Institutions are either very low levered or no leverage, or if they do have leverage, have the balance sheets to service it and pay it off and refinance and so on. So the market itself is way more stable in Canada from a financing perspective than it is in the US. Because of all that, the output of all that is that there's way fewer trades. In a down market, there's just fewer trades. There's less pressure. There's less distress. So there's less trading. With less trading comes slower write-downs, and that's what you're describing. So, appraisers, God love them, and they had a tough job over the last couple of years, and I think by and large they've done a relatively good job. But appraisers look to past historical transactions to mark values to market. With less transactions, there's less to mark. Write-downs take a longer period of time. All of that said, where we find ourselves today actually is we've spent 2 years writing our assets down. Canadian institutions have spent 2 years writing their assets down, quarter by quarter, 25 beeps at a time, right? We all know the process. It's been like death by 1,000 cuts. But here we are, 2 years into the process. Most institutions have taken material write-downs on a lot of their assets, and that's why you're seeing assets start to trade, right? And kudos to our friends at Primaris, for example, who have picked up, I don't know, it's got to be at least 3 or 4 malls over the last 12 months, right? These are all institutional malls. Now, those malls wouldn't have traded 2 years ago because the assets hadn't been written down yet. Now they're being written down. We're hearing about some office trades in the works, right, from institutions who again have spent the last 2 years writing their values down. So that's what I mean when I've been saying, the ask is starting to meet the bid. So for the last 2 years, we've had this bid-ask spread that has really halted a lot of transactions. We now find the ask is meeting the bid. It's taken a while to get here, but we're here. So we can now, as an investor who's looking to place capital and invest in new assets, you can buy. That's why you can buy institutional quality assets today. They're finally willing to meet the bid. You can buy best-in-class assets from Canada's largest and most sophisticated institutions at cap rates that you think make sense. You can finance them properly because our banks are strong. There's lots of liquidity in the credit system. So that's all working well. And if you have the fundamental belief that you can maintain leasing, which I do personally, not everyone does, but I fundamentally believe that, then that is an enormous opportunity for those who have access to capital. That's the last piece of it. Not everyone has access to capital. So when you think about all the negativity going on at some of these conferences and what I would call despair, I mean, I hate to use that word, but it does feel like despair. A lot of it is because investors either don't believe they can keep the buildings leased because they can't cut out the noise, or they don't have access to capital. You need both those things to make it all work.
Rob, thanks so much for coming back on to spend time with us.
Yeah, we got to stop there, right? That was perfect.
Great,
that was
great,
the drop the mic, walk away. See you, Rob.
My pleasure. Thanks, guys. Appreciate you having me on.
Yeah, of course, we want to thank the Canadian Real Estate Forums for hosting us here at the RealCapital Conference as part of their speaker video series, First National, for powering the podcast. But again, Rob, thanks so much.
My pleasure. Always great to be with you guys.